Okay, hi, I'm Katie from Foden Property, and we are delighted to invite our first guest to our podcast. So this is Nathan from Dwello Mortgages.
Hi everyone, I'm Nathan from dwello Mortgages, Director and Principal Advisor. We've been practicing for the last 3 years and we're here to discuss the mortgage market currently with Foden's help.
So we thought we'd talk around, obviously the mortgage market is very interesting at the moment. There's a lot going on. There's a lot of stuff in the press. Some of it's quite scary. And I thought we'd just sort of talk around it a little bit and see if we can calm people, let people know what to do if they need help or advice or where to reach out, what to do about things. So, Nathan, what's your take on the house prices? Are they falling?
Well, we've seen that there might be a crash or a proposed crash in the market. It might be a correction. It might be a case of people have over-leveraged themselves over the last couple of years. But what we've seen currently is down valuations from lenders up to £50,000 in the last 2 to 3 months.
Yeah.
So there could be cause for concern for people with high loan to values currently on their property. If there is a client that has a lot of equity in the property, it shouldn't affect them too much.
Yeah.
But it is a cause for concern currently.
Yeah, it's definitely something. It's really difficult because coming out of COVID, the house prices went wild, didn't they?
Yeah.
And I think that what's happening is it's whether or not we think there's actually an actual crash on its way, or whether we think that if people allow the market to correct, a crash could be avoided. I mean, I was sort of, unfortunately for me, I was in the property market when the 2007 crash happened. And the precursor to that, there was a period of time in the early 2000s where the market slowed. There was a bit of adjustment in prices, and then it paused, and then it just went wild.
Right.
Which led then to the 2007-2008 crash. So I kind of think that people need to get their heads around the fact that this cooling of the market is potentially a bit of a correction for the fact that it got overexcited coming out of COVID.
Right, yeah.
We too are seeing the down valuations on mortgages. We are trying to advise clients. The worst scenario is that you go out, you value a property, goes on a bit higher than you actually realistically think it is. You get a buyer for it, gets down valued, and the whole chain falls down, doesn't it? So what we're trying to say to people is be realistic. You know, if it feels like it's a bit steamy, it probably is. So we're trying to encourage people from our side of it to put properties on the market at a realistic price for exactly this reason.
Yeah. And have you found any gazumping in the market from when the pandemic hit? There was quite a lot in terms of people coming in last minute and buying.
Oh God, it was fierce. It was absolutely fierce, and that's definitely cooled. So where we would have like really aggressive bidding on properties, that has definitely cooled. And we're also finding now that anything that is a little bit toppy, which we would have got away with 6 months ago, is now sat. Until it reaches its correct level, no one's going for it.
Right.
The offers are coming in lower. So there is an attempt for the market to correct itself a bit.
Yeah.
Which would help us all.
So an organic correction.
An organic is what we want, isn't it? We don't want a crash. We don't. I mean, there's always people who win in the crash. But we don't want it if we can.
If we can help, exactly, yeah.
And I think you're absolutely right. I think where people have stretched, you know, because of that situation with all the gazumping and everything that went on, they're the people who are going to really struggle if they've done a 2-year fixed, say.
Yeah.
And they're coming up to remortgage. Yeah,
like I discussed earlier, I had a client. He had a 2-year fixed. Him and his partner bought it in 2021. It was on about £900 for the mortgage itself, and now it's going up by £400. So he's paying just shy of 1,350. So and that's going to obviously strain in terms of their budget per month if they've got a small child. But this is the kind of market we're living in at the moment, and it's about trying to find him now a mortgage that fits his affordability.
Yeah. How available are mortgage products? Because obviously we keep going through these waves, don't we, where they're all pulled, and then there's more released, and then they're all pulled again, and there's a big drama, and there's no mortgages, except 2 weeks later there is. How volatile is it actually really from your
it's a very, very volatile market at the moment. It's almost like the brokers and the lenders are playing some type of dance with each other. But from the start of, the end of last year, where there was maybe 12, that changed over the course of the next 3 months, where it went back to normal. We had over 2,500 different kind of products from all the different lenders, and like I said, week on week, lenders will pull them. Week on week, lenders will increase the rates. Sometimes day on day, they'll increase the rates. So one of the biggest ones currently with HSBC, they were the market leaders in pretty much all the loan to values. But because everyone was going to them over the last month or so, they've now pulled all their products and they're not taking on any new business. There's a few others that are following suit. So when it comes to kind of trying to place a client based on affordability, and they're the cheapest on the market, and then maybe a client's dragging their feet or they're not in the right position to get it done, 2 days or even a week down the line, we come to sort out the mortgage for them and the product's no longer there. It's a real kind of punch to the chest, really. It's
quite interesting, isn't it? Because the lenders are obviously nervous about their mortgage book. Which again is reflective of what happened in 2007 and 8. They all got stung, didn't they, with their mortgage book. So you can see there is this cautiousness with the lenders. They can't see the future, can they? They're all a bit scared, presumably.
Yeah, definitely. They obviously want to be taking on as much vanilla stuff, which means the easy kind of 2 incomes in a household. No ridiculous adverse credit or high spending. But when it comes to affordability and they're the cheapest in the market, everyone's going to want to go to them. And it's also them protecting their service levels, because previously HSBC, for example, you could get an application over the line or into an underwriter within, say, 3 to 4 days. And that changed to about 15 days over the last couple of weeks. So they're taking on and servicing so many new mortgage clients that they actually can't deal with the capacity. So that's another reason why they then decide to pull the product.
Okay, so they're drowning. So with 2 to 5 year products, what's the main focus for potential borrowers? Where do you see the interest rates going? What do you think what do they need to consider when they're fixing?
Of course.
Is it better to fix longer term, shorter term? What's the advice?
Well, the advice on this particular aspect of the market is really, what is your appetite to risk? We're on obviously not an unprecedented high, because in 2007, 2008, there were really, really high interest rates. So this is usually, it should sit around 3.5% to 4% for an interest rate. So it is higher than usual, but not unprecedented. But when it comes to looking to the future and obviously budgeting for the future for your family, we need to look at is, do you expect, from the knowledge that you have and the knowledge that we can give you, that the interest rates are going to be better in 2 years' time? Or do you think maybe 5 years on a higher interest rate would work best for you for, to budget accordingly? Because obviously everyone lives to a budget. Do you feel like by just having a 5 year and knowing this is the payment I'm going to be stuck to for 5 years is worth your peace of mind? Or are you more inclined to think, in 2 years' time, I hope and I expect the interest rates to have corrected and come back down?
It's a risk, isn't it?
It is a risk, and it's a bit of a gamble, because
2 years isn't very long, is it? Let's face it. The last 3 years have just gone.
Exactly. So a 2 year fix will obviously benefit someone that is maybe in a high interest mortgage at the moment, or a high loan to value, and they need to get something quick to then refinance in a couple of years' time. What
is the difference in the rates for so is there a significant difference between the 2s and 5s?
Marginal. I'm talking like 0.2% difference in lenders' products from a 2 year and a 5 year. It's very marginal.
So if you're going to do a 2 year, you've got to be fairly convinced in your own mind that the interest rates are going to go down.
Haven't you?
Yeah. Because over 5 years, it is likely that they will peak if they haven't already. then correct back down.
What people don't want to do is have a 5-year fix, and then in 2-3 years' time, the market corrects and goes down, and they're stuck for another 2 years on a high interest rate. And I understand that, because no one wants to be losing out on money that they don't have to be spending.
Yeah.
But in those situations, there are options for clients to then pay an early repayment charge on their mortgage product, which will allow them to come out of that product and secure something cheaper.
Yeah.
So there is an option to do that as well. The third option, which most people don't really discuss because, again, it's a risk, is a discounted rate, which is a lender's variable rate discounted by a percentage of maybe 3%.
You don't hear people talk about those anymore.
No, yeah. It's mainly buy-to-let landlords that would deal with a variable rate, purely based on the fact of if they wanted to get rid of a property, they could with a drop of a hat, because there's no early repayment charges into that. So this is another area we could look at for clients where a 2-year fix might not suit them on a high interest rate. A 5-year fix might not suit them because of the length of time. So maybe a 2-year variable rate at, say, 4%, 4.5%, because the variable rates are a lot cheaper than the fixed rates currently.
Right.
If you do that, and say in a year's time the interest rates then drop to maybe, 5%, 4.5%, you could then tie into a 2-year fix then, and you'll have at least come down from the high interest rates of 6% we're currently seeing at the moment.
Back in the day, going back a little while, I actually had a base rate tracker with Barclays, and it was 0.2 above base, and the base rate went din, 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 din. I was basically paying nothing for a mortgage. It was a joke.
Yeah.
But go on the other side.
They're not around anymore.
No. And on the other side of that, when I first got a mortgage when I was in my early 20s, 6% was a good rate.
Yeah.
So it's all kind of relative. The difficulty is that the house prices have escalated so much that actually just funding that property is now
it's a mammoth task.
Yeah.
Absolutely. Well, we live in an economy where previously only one income for the household could support it.
Yeah.
And now we're in an economy where even two is struggling.
Yeah.
So it's really something maybe the government need to look at, in great detail to help people in a world where affordability is key, and maybe people have overstretched themselves because interest rates have been so low for such a long period of time. People have maybe been a bit spoiled. I don't know.
Yeah,
but,
I think you're right.
Maybe it's just a natural correction in all aspects of the financial kind of services.
The difficulty is that people who can't afford to buy, it's not like renting is cheap.
No, yeah, you're right.
The rents are horrendous as well, to be honest.
Yeah.
We're watching and we're facilitating, and we have to, where landlords' mortgages have gone up massively all of a sudden. They're refixing and whatever. And that's having to be reflected on rents. So rents are also being impacted by the interest rates. Yeah. So there's nowhere to be immune from it. No.
Yeah.
So what are the main industry changes that you've seen of late? What things, what is your feeling about? Because your sector must be really stressful at the moment. I mean, years and years and years ago, I was a mortgage advisor. Wouldn't want to touch it now. Didn't really want to touch it then, if I'm honest with you. But
I mean, well, with the industry at the moment, everyone's trying to be innovative and create something where people can gain value from their product. So we heard with Skipton with the 100% mortgages a couple of months back. It didn't really transpire to something that was actually viable for a lot of people, purely based on the stringent criteria. But there are other things that the industry are looking to do, along with changing fixed rates to interest onlys. So people that are on repayments for obviously a 2 or 5 year fix for 6 months can now change their product to interest only to alleviate some of that pressure of that financial burden month to month. That's coming recently through the government. Another thing that we're looking at to do in the financial services is instead of paying your mortgage after tax, there's a scheme to put in place, or that's been lobbied in government.
I saw that.
Yeah, where we can actually pay the mortgage before tax, and that alleviates a bit of financial pressure.
Do you reckon they'll go for that? I actually think that's great. I think that would be
sense.
It's a really good way of doing it.
You can do it for your car. So
it's true.
Why can't you do it for your mortgage? Everyone has a mortgage, or most people do, be it a residential or buy to let. So it makes sense that this is something, it's an essential need for people to have obviously a home and a household. So to be taken out before tax makes a lot of sense, because you're basically paying tax twice on it.
Yeah, I do. I saw that in the trade press the other day and thought, actually, that's a really, really good idea.
Yeah.
Yeah.
So we'll watch this space on that. It hasn't been agreed yet, but it's something that's been brought up for the government to have a look at.
Yeah, well, hopefully enough people support that.
Yeah.
Yeah. So, do you foresee a property crash? Do you think there's going to be one?
I feel like there'll be a blip in the market with the down valuations, with people holding out, because what I've seen again in the market, I've got a lot of clients ready to go, but they want to wait. And they want to wait to see what happens. And yes, that's a good thing in hedging your bets, but at the same time, there's no perfect time to do anything.
No.
You either do or you don't. But what I have seen is people waiting and are hoping that the interest rates get better. Unfortunately, they're getting worse, but that's something that's holding up the property industry in terms of us going backwards for valuations and property prices. So I don't see it being a crash as in 2007 to 2008, but there will be a correction, like you said, and maybe an organic correction to the market.
Yeah.
That we might see towards the end of the year, and obviously, hopefully by then, the interest rate will have corrected itself and aligned itself with the valuations of properties, where we can then push on and see bigger returns.
And what's your advice to anybody who's heading towards the end of a fixed rate, or their help to buy schemes coming up for renewal, or a landlord that's mortgage scheme is coming to an end? How far in advance do they need to start doing something? I mean, I think the overarching thing is, don't allow yourself to go onto a standard variable rate. That's it, isn't it? Get everything in right.
Yeah.
So what's the advice? What's the timescales and the guidelines, and what would you say?
First and foremost, speak to an advisor. I mean, we can help you.
Lots of people try in this sort of climate where they're nervous. They go to their own banks, don't they?
Yeah.
Or their existing lender.
Which is fine, but a lot of banks and lenders don't actually advise anymore.
No. So
they can only offer you the product that they can offer you. It might not actually be totally suitable for your current situation.
Yeah.
2 years ago, when you went to the bank, you might have been single, you might have had a partner but no kids, or you might have lived somewhere else in the country. And after those 2 years, a lot of things can change. So we can then evaluate you as you are and find the best product available to you at this situation, and apply that on your behalf. So definitely speak to an advisor, because we have the inside knowledge of what's going on, the do's and don'ts of the industry, what lender will take what, if it's self-employed, contractors, all those kind of niche products that are available to people that you probably wouldn't hear in mainstream media. And along with the high street banks, yes, they are the ones that people would usually go to, but there's so many different lenders in the market that people have never heard of that we can actually go to and possibly get that mortgage for you.
Yeah, and I think that's something that needs to go out to landlords in particular as well, because I think landlords run a portfolio, and like they would stay with their own agent to run their portfolio, they tend to stay with a bank or a lender for their portfolio. And I think that this is the time to open your horizons a bit and actually, look for somebody who can talk you through the whole thing.
Yeah, definitely. We're here to help. We're here to advise. I'm more than happy to have 10, 15, 30-minute conversation with anyone just to get all their ducks in a row, so they at least know where to point and shoot. It's all about planning and executing, really. That's my job. I plan on what you're looking to do and how you're looking to do it. And then if you're happy with what I've given to you, then we can execute it and go to the lender. Yeah.
So, people, Nathan, if you've got any questions, queries, anything like that, please, you can contact us, contact Nathan directly. You need to get advice. That's the answer, isn't it? This is a shifting sands. Get the advice you need.
Cheers.